Dollar cost averaging versus lump sum investing. The real math. Sarah has $24,000 sitting in her savings account. She has been reading about investing for 6 months. She knows the S&P 500 averages around 10% a year. She knows time in the market beats timing the market. She is ready, but she is also scared. The market feels volatile. She keeps reading headlines about corrections, recessions, and inflation. So, she makes a decision that feels smart, responsible, and almost universally recommended. She will invest $1,000 a month for the next 24 months. Spread the risk. Ease in. Dollar cost averaging. Mike has the same $24,000. He reads the same headlines. He is also scared, but he does something different. He wires the full $24,000 into VOO on a Tuesday morning in January. All of it, at once. His coworkers think he is reckless. Sarah thinks he is going to regret it. Here is the thing. One of them is right, but it is probably not the one you would guess. And the gap between their two accounts after 20 years, the gap will make your stomach drop. Let's keep this fair. Sarah and Mike are both 30 years old. Both earn $60,000 a year. Both live in the same city, pay the same taxes, and both have exactly $24,000 saved up. Money they do not need for emergencies, do not need for bills, and are ready to put to work. Both invest in VOO, Vanguard's S&P 500 ETF. Same fund, same expense ratio of 0.03%, same brokerage. The only difference is how they deploy that $24,000. Sarah, $1,000 per month for 24 months, consistent, controlled, spread across 2 years of market conditions. Mike, $24,000, one transfer, one confirmation email. Done. That is it. That is the only variable. Let's follow the math. Sarah sets up an automatic transfer on the first of every month. $1,000. It hits her brokerage account, buys whatever VOO is trading at that day, and she moves on with her life. Month 1, she buys 4.8 shares at $208. Month 2, the market dips and she buys 5.1 shares at $196. Month 3, back up, 4.7 shares at $213. She is averaging down on the dips, up on the peaks, and the cost of her shares is smoothed out across 24 different price points. This is exactly what every personal finance blog tells you to do. Systematic, disciplined, psychologically manageable. Sarah feels smart. She is not panicking. She is not checking the market every hour. She said it. She is forgetting it. And every month she gets a small dose of confirmation that she is doing the right thing. When the market drops 12% in month 7, Sarah does not blink. She just buys more units at a lower price. She tells her friends she is buying the dip without even trying. They nod. They think she sounds like she knows what she is talking about. She does know what she is talking about. But feelings and math are two very different things. Mike does not do any of this. On January 3rd, he transfers $24,000 to his Fidelity account and buys VOO at the market open. He gets 115.4 shares at $207.96 per share. Transaction complete. He closes the app. He does not bring it up at dinner parties. There is no monthly ritual. There is no story to tell. He just wired it all in at the start of the year. Nobody thinks that sounds smart. It sounds lazy, or lucky, or dangerously overconfident. His coworker Jake asks Mike what he did with the money he had been saving. Mike explains. Jake says, "What if the market crashes the week after you put it all in?" Mike does not have a great answer for that, because Jake's question is completely valid. Here is what Mike does have: 24 extra months of full market exposure. That is the number that does not fit in a Reddit thread about dollar cost averaging. In year 1, Sarah is winning the story. The market is choppy. There is a correction in the second quarter. Sarah's average cost per share is $201.40, slightly better than the $207.96 Mike paid on day 1. She has bought the dips. The dollar cost averaging is working exactly as advertised. Mike's account is down 3.2% on paper. He is not panicking, but he is also not bringing up his investment account in conversation. Sarah has $11,800 invested so far. Mike has the full $24,000 deployed. Sarah's cost basis looks better. Mike's absolute position is larger. What that snapshot does not show is what happens when markets go up. The market does not spend most of its time going sideways or down. Historically, the S&P 500 closes higher year over year roughly 73% of the time, which means that in most 24-month windows, the market goes up, and every month Sarah waits to put money in, she is missing some of that upside. By the end of month 24, Sarah has fully deployed her $24,000. Mike has had his full $24,000 working for exactly 2 years longer than Sarah's last dollar did. That 2-year head start is worth more than Sarah's smoother cost basis. Here is where it gets interesting. Let's run the actual numbers. We will use S&P 500 historical returns, approximately 10% annualized before inflation, roughly 7% after inflation. We will model both scenarios over 20 years from the point Sarah finishes her dollar cost averaging. But first, we need to account for those 24 months of deployment. While Sarah is dollar cost averaging her $24,000 in over 2 years, her average dollar is in the market for about 12 months during that period. Mike's full $24,000 is in the market for all 24 of those months. At 10% annual returns, Mike earns roughly $4,600 more in unrealized gains during just that 2-year deployment window. Sarah finishes investing at month 24 with a portfolio worth approximately $26,400, her $24,000 plus partial gains during the dollar cost averaging period. Mike finishes month 24 with approximately $29,040. The gap at the starting line, $2,640. That is before the real math kicks in. Year 5, which is 3 years after Sarah finishes deploying. Sarah, $26,400 compounding at 10% for 3 years, approximately $35,140. Mike, $29,040 compounding at 10% for 3 years, approximately $38,650. Gap, $3,510, growing. Year 10. Sarah, $26,400 at 10% for 8 years, approximately $56,560. Mike, $29,040 compounding for 8 years, approximately $62,210. Gap, $5,650, still growing, year 15. Sarah, $26,400, compounding 13 years, approximately $91,010. Mike, $29,040, compounding 13 years, approximately $100,100. Gap, $9,090. Now it is real money, year 20. Sarah, $26,400, compounding 18 years, approximately $146,500. Mike, $29,040, compounding 18 years, approximately $161,100. Gap, $14,600. Mike ends with $14,600 more on the exact same $24,000 investment, in the exact same fund, over the exact same time horizon. The only difference was a Tuesday morning decision to not wait. That is not luck. That is math. And that is the number that does not fit in the headline dollar cost averaging protects you from volatility. This is not just a model. The data backs it up. Vanguard ran this analysis in 2012 across 3 major markets, the US, the UK, and Australia, using 10-year rolling windows. They found that lump sum investing outperformed dollar cost averaging approximately 2/3 of the time. In the US specifically, lump sum beat dollar cost averaging in roughly 68% of all 10-year windows going back to 1926. The average outperformance? Around 2.3% per year in the first 12 months after investing. That sounds small. Over 20 years of compounding, it is not small. Northwestern Mutual ran similar analysis in 2021. Same conclusion. Lump sum wins more often than not because markets trend upward over time. Every month you wait to invest is a month you are potentially missing a market that statistically closes higher more often than it closes lower. That is not a fluke. It is the fundamental logic of a growing economy. If I only showed you the lump sum wins, I would be doing what every finance channel on YouTube does, cherry-picking the conclusion and ignoring the asterisk. Here is the asterisk. The Vanguard study says lump sum wins 68% of the time. That means dollar cost averaging wins 32% of the time. And in those 32% of cases, specifically in bear markets, in the months before a significant correction, in periods like late 2021 or early 2000, dollar cost averaging does not just win slightly, it wins decisively. If Sarah had started her $24,000 in January 2000, right before the dot-com crash, her dollar cost averaging strategy would have bought fewer shares at higher prices early on and more shares at lower prices during the crash. By 2003, her portfolio would be meaningfully larger than Mike's. Same story for someone who lump summed in October 2007, right before the financial crisis. The problem is that nobody knows when those periods are happening until after. There is also a behavioral argument that deserves real respect. Sarah's strategy is not just about math, it is about psychology. If Mike puts in $24,000 and watches the market drop 30% in the next 6 months, the question is not whether the math eventually works out. The question is whether Mike actually holds. Research by Dalbar consistently shows that the average equity fund investor underperforms the market by roughly 1.5 to 2% annually. Not because of bad funds, but because of bad behavior. Buying high, selling low, panic selling during corrections. If Mike is the type of investor who would sell at the bottom, his lump sum advantage disappears immediately. Sarah's dollar cost averaging strategy, by reducing her initial exposure, may help her stay the course. That is a real argument. Not every investor is Mike. And there is one more scenario where dollar cost averaging legitimately wins. When the money is not available all at once. If Sarah is investing $1,000 a month because that is what her paycheck allows, not because she has $24,000 sitting in savings, then dollar cost averaging is not a strategy, it is a reality. And it is a great one. That is not what we are comparing here, but it is worth naming. So, which one should you do? Here is the framework. And it has conditions. First, if you have a lump sum available, and you have a long time horizon of 10 or more years, the data strongly favors investing it all immediately. The math is clear. More time in the market beats better entry prices in the majority of historical scenarios. Stop waiting. Open VOO, hit buy. Second, if you have a lump sum available but you are in or approaching retirement, reconsider. A 30-year-old who invests a lump sum and watches the market drop 40% has decades to recover. A 62-year-old does not. In the 5 to 10 years before and after retirement, what financial planners call the sequence of returns risk window, dollar cost averaging, or even a more conservative allocation may protect you from catastrophic timing. Third, if investing the lump sum would cause you to panic sell during a correction, dollar cost averaging wins. This is the behavioral override. If you genuinely do not know how you would react to watching $24,000 turn into $14,000 on paper, dollar cost averaging removes that stress. A strategy you can maintain beats an optimal strategy you will abandon. Fourth, if the money comes from your paycheck monthly, dollar cost averaging is not a choice. It is the only option, and it is a good one. Do not let this video convince you that dollar cost averaging is wrong. It is not. For most people building wealth through regular contributions, it is the default, and it works. The question this video answers is only about what to do when you have a lump sum sitting in cash. Fifth, never let fear of the wrong entry point keep you in cash longer than 3 to 6 months. Cash is not a safe haven. It is a slow erosion. Inflation runs at roughly 3% annually over long periods. Every month, your $24,000 sits in a checking account, earning almost nothing. You are losing purchasing power. The expected cost of waiting almost always exceeds the expected cost of bad timing. If you are going to dollar cost average, set a hard end date, 6 months, 12 months maximum, then get fully invested. Let's go back to Sarah and Mike. Sarah did not make a bad decision. She made the smart decision for someone who needed to manage their psychology, reduce early exposure, and build a habit of consistent investing. If Sarah is the type of investor who would have sold in March 2020 when the market dropped 34% in 33 days, her dollar cost averaging strategy may have saved her from a far more costly mistake. Mike made the mathematically optimal decision. For someone who has the discipline to hold through volatility, the time horizon to absorb drawdowns, and the emotional resilience to ignore the noise. The difference after 20 years was $14,600 on the same $24,000 investment in the same fund. That is not a rounding error. That is a real number. And it came from nothing more than the willingness to stop waiting. But here is the honest conclusion. The Vanguard study says lump sum wins 68% of the time. It does not say 100%. The 32% of cases where dollar cost averaging wins are not random. They cluster around market peaks, and market peaks happen. We just do not know in advance which months they are. So the question is not which strategy is better. The question is, who are you as an investor? The next time someone tells you to dollar cost average, ask them one question. Do you have the money available right now, or are you waiting because the market makes you nervous? Because the answer that includes your actual psychology is the only answer that matters. And if you are wondering what happens when you compare dollar cost averaging into a Roth IRA versus a traditional 401k, when the tax treatment changes the whole equation, that is a completely different conversation. And the math might change everything you think you know.